Good afternoon, Joe Mass here. Hey, we just wanted to give you a quick update, give you a quick special note. We have the coronavirus hitting the headlines and the markets are kind of going crazy. So we just thought that we'd give you our thoughts. And if you have any further questions, of course, give us a call. So let's just walk you through what's going on. So before I do that, I am going to I'm going to introduce myself. I'm Joe Mash. I'm your Chief Investment Officer, so you probably know me, so I'll skip that slide today. But we're going to go over a quick introduction, and then we're going to go through a quick overview of investing, and then we'll dive into the coronavirus specifics, okay? So the reason I want to talk to you about the process is that processes drive success, okay? Everything we do is based on a fiduciary institutional process, and that's how we make decisions. So when we see the market drop like it has over the last couple of days, we're not making ad hoc decisions or adjustments to the portfolio based on that emotion and based on the headlines. We need facts and data that can go through our process to drive our decision-making process, okay? So as you've been taught, right, what does the perfect investment look like? So you might have heard that 100% liquidity, that'd be a nice feature to an investment. Not being able to lose any of your gains, right? An investment that can never go down, that would be great. And then of course, double-digit returns, that sounds good. So, what is this perfect investment? Well, we all know that it doesn't exist. It's this pink unicorn, okay? So what can we do? Well, what we want to do is we can pick two out of these three attributes. So we can have investments that are liquid with some protection. We can have protection with some gains, and we can have some gains with some liquidity. So it's kind of like ABC. You can have this red money and green money. Green money is safe, can never go down, and red money is subject to market risks, but it also has a potential for higher gains. And so via the financial planning process, by following this ABC process, or by following a portfolio that's designed to have the perfect investment in it, these different attributes, this is what's going to protect you ahead of time from days like we've seen this week when we have a coronavirus outbreak, or we have an event that sends the markets into a tailspin, okay? So it's pretty late in the game if we're making decisions now after the fact, and that's why you can rest assured by having a well-diversified portfolio and a good financial plan that's integrated with your investments. That's your defense, and you've already got it on the field before you need it. So you can feel really good about that. So a quick overview. This chart shows the S&P 500 since 1953, and it looks like it goes straight up, right? It's been a buy and hold market. You can't lose money. Look, it's just gone up like gangbusters. So we all know that there's periods of volatility. The blue bars here show the drawdowns of 5% in the market. The yellow bars are 10% drawdowns, and the reds are 20% drawdowns. Now, if we try to avoid all of the blue and yellow bars, we're going to also, by definition, avoid those returns. And so we're not seeking to avoid all of these 5% drawdowns, but to minimize the reds. And so this week, Monday and Tuesday, the market had a 2-day drop that was historic, okay? And, it was like a blue bar. But we're not as overly concerned with those blue and yellow bars, because we know that if you have a 5% drop, that you only have to earn 5.26% to break even. Okay, so we haven't dug a hole that we can't climb out of. If the market can do 7% over the long run, which is no guarantee, but historically, if it could do 7%, it would only take you 7.6 years to break even, right? So 0.76 years, so that's less than a year. At being down 10%, you only need 11.11% to break even. So again, at 7%, you can break even with a year and a half. So if you are nearing or in a work optional lifestyle, a 5 or 10% drawdown isn't going to derail your retirement, okay? Let's talk about investing for a few minutes before we dive into the coronavirus facts. So there's two sides to the investment coin. One side's heads, one side's tails. Risk on, risk off, right? And so the trick is is making sure that you have enough balance between your risk on and risk off assets that you can sleep tight at night, okay? So some people are comfortable being 50-50, some people are comfortable with 70% risk off, 30% risk on, and anywhere in between, okay? So if you are finding yourself concerned about market volatility or global geopolitical events that are disrupting the markets, just give us a call and we can reposition your portfolio, okay? So an example that we have is if you were 50% risk on and 50% risk off, as you can see here on this chart, if the market went up 7%, okay, or if you had, let's say, a risk off asset like an annuity or a structured note or a CD that could go up 4%, and if you're weighting 50-50, you can see that on the upside, you'd end up with a 5.5% return. And if the market dropped 20%, because you only have 50% in the market, your portfolio would only go down 10%. Okay, so let me just review that again. You have 4% on the upside in, let's say, an annuity, and you have 50% of your money in that investment vehicle. Okay, so it can go up 4, but it can never go down. You have the other 50% of your money on a red money strategy like the stock market, like the focused growth or a focused dividend or a focused tactical allocation model that we call the sailboat. So you have 50% in that. Well, if the annuity goes up 4 and you have 50%, 50% times 4 is 2. If the market went up 7, 50% times 7 is 3.5. And so the weighted average portfolio return would be 5.5. On the downside, 50% of 0 is 0, and 50% of -20 is -10, and there's your 10% downside. Okay, so that's just an example of a 50% risk on and a 50% risk off portfolio. So you need to make sure that you look at your total portfolio when days like Monday and Tuesday hit, because that green money and your CD money and your cash and your other assets, your risk off assets, are not going down while the only portion of your portfolio is being subject to the market. Market whims are going to be the market risk or the red money, the risk on money. Okay, the coronavirus. So we've been doing a lot of research. We're getting ready to rebalance portfolios this week. And so it was very timely. And in doing our research, we're really 50-50. We're getting a lot of evidence that we should still be a bull. And we're getting a little bit of evidence of a correction and a bear market. So it really depends on the time frame you're looking at. Long term, we have a lot of evidence that we should be staying in the market, should be long. And on a short-term basis, we have a little bit of evidence that we should be more defensive, okay? Well, 2 days of market drop is not enough data, not enough history for us to worry about that data. We're concerned about it, we're watching it, and we are going to make some portfolio adjustments, which I'll mention in a few moments. But 2 days is not enough for a trend, okay? It's a geopolitical spike based on this corona event, okay? Now, in the past, these events have been more severe. The market's been very resilient since the coronavirus is hit. I'm not an expert on the coronavirus, so a lot of these are statistics that we've read today, but I think as close to 25,000 people have recovered from the coronavirus out of the 80,000-ish. The death rate is very sad, but it's low. It's 2%. It's the common cold and flu kill more people in America than we've seen killed by the coronavirus yet. Now, a few weeks ago, some of my PhD buddies told me that they thought the coronavirus would be very widespread and deeper than most, and so I believe them. And it probably will get a little bit worse before it gets better. We don't know. However, that's really hard to quantify what that's going to mean economically. Okay, so we can't take a lot of action on that. So we can only take action on facts and data that we have. Okay, but we're very adaptive. So as the data changes, we will change. Okay, so right now we're not panicking. Right, we don't have enough data to call a new bear market. But if we get the data coming in, we'll continue to adjust the portfolios. So on one side of the coin, we're bullish, and one side of the coin, we're bearish. On the bullish side, this chart is showing you what's called the moving average envelope. And don't worry about it. It's a statistical process to look at the market. And it's one of the best ways. It's been one of the most predictive indicators of what the market might do over the last year and over the last 2 months. And so what you can see here is when that white line breaks down below that orange line, that's actually a buy signal. Okay. And so you can see that the white line has dipped way below the orange line. And so based on this indicator, this would be a very strong buy signal. Okay. And if you think about it, it makes sense. What do you want to do? You want to buy low and sell high. So, you don't want to sell when the market just dropped over the last 2 days. And so this indicator is giving us evidence that on one side of the coin, it might be time to actually go back in and buy more and put cash to work, okay? On this chart, this is on the other side of the coin. This is more of a bearish chart. This is showing the 50, 100, and 200-day moving average against the S&P 500. And as you'll see, the white line has broke below the magenta and green line. And you'll see that it just now, these are live charts as of today. I just printed these off my Bloomberg terminal here an hour ago or so. So the price is now just broken below the 50 and the 100-day moving average. And those are both bearish signals. Those would lead us to want to raise more cash or become more defensive in the portfolio, okay? So on one side of the coin, you can see here we have evidence to be bearish. And then of course on this slide, looking at the moving average envelope, fancy word, fancy indicator, we have bullish evidence, okay? Well, let's look a little further. Here's a chart of the volatility in the S&P 500, and the white lines represent 1% up and 1% down. And so the S&P has been pretty much bound, a range bound. Volatility has not really been a big problem, except you can see that big spike. I'll move my mouse right here. You can see this spike this week where volatility really broke out, but then it's popped back up into this normal range of -1 to +1. Okay, so volatility has not been a systemic issue. But of course, on an outbreak like this, we had this violent outbreak with a news story and coronavirus, and we saw that volatility spike. Okay, so if that spike happens and it smooths out, we're not going to be as concerned. We will be more concerned if we start to see more volatility dropping below that white line in that down 1% range. So again, volatility is still quite. It's quite fine for what we're looking at right now. So again, we have some evidence for risk on. We have some evidence for risk off. Now, you guys have been listening to me for a while, so you all know this, but I'm going to reiterate it again. What drives the market? There's really 3 primary things, and then a 4th ancillary thing that moves the market: interest rates, inflation, and corporate earnings. And all of those are still okay. The coronavirus outbreak and Monday and Tuesday's drops have not really been driven by any fundamentals in interest rates, inflation, or corporate earnings. Now, 38% of the S&P 5 companies are now coming out, and we're finding verbiage in their earnings reports. And so we do expect it to affect some companies and some suppliers. And it may go down for another 3 months or 90 days. We don't know. But long term, there's not evidence looking at historical epidemics that we're going to see a sustained decline in fundamentals. And then, of course, the Fed is capitalized because you never want to fight the Fed. The Federal Reserve is still very accommodative, okay? They're not tightening, so they're not trying to choke out the economy. And so, again, that's still another reassuring bullish indicator. So the long-term fundamentals still look good. A couple days of market correction have not changed that. We'll continue to monitor it, and we'll keep you posted. Now, what to do? Okay, what to do really depends on you if you have a long-term view or short-term view. 5 years from now, you're probably not going to remember Monday and Tuesday, and the market most likely will be up. Okay, and earnings will be fine, and companies will be doing just right. If you're worried about the next 30 or 60 or 90 days, that could be a different story. We could see the coronavirus continue to spread. We could see it, affecting us here at home, and the markets could continue to panic and drop. Okay, so in the short term, we could see some more risk on the short side, but the long term, driven by the fundamentals in the Fed and in prior historical events, we're not as concerned with at this time. So what else can you do? Reassess your risk on, risk off. So again, if you're feeling a little nervous, just let us know and we can reposition the portfolio and balance you from maybe you were 60% risk on and 40% risk off. Well, we could reposition you to be 50-50. Or if you were 50 risk on and 50 risk off, and you're like, I think I want to take advantage of this, well, then we could increase your risk and decrease your risk off. So we can adjust the portfolios up or down based on your personal circumstances if necessary. Just let us know. So now some things that we're doing is we're gonna rebalance portfolios this week. In some of our portfolios, we've already raised cash, and so we had cash prior to Monday and Tuesday, so that's helped us out. And our sailboat portfolios, we're going to be trading those tomorrow, and 75% of the portfolio is going to be on a risk-on posture, and 25% of the portfolio is going to be using either a shorting instrument, excuse me, or cash. Okay, so we are shoring up. We are being a little conservative. We're not 100% risk on. We are taking a little bit of risk off the table to be cautious, and then the investments that will remain invested, or the risk on part of the portfolio, there you'll see some utilities, you'll see some more defensive types of equities entering into the portfolio. So we're making some adjustments based on the data that we have, not just based on the last 2 days. So you will see that happening, and the portfolios will be repositioned automatically for you. So again, we're going to do our job and keep up with this and rebalance things. If you're feeling a little bit of nervousness or excitement, and if you want to take advantage of the dip, or if you want to raise some more cash, just let us know, and we'll be happy to accommodate you. So again, thank you for listening to our quick thoughts. If you need to discuss anything further, please let us know, and we thank you for your business.